So this week, unfortunately, the recording cut out at the beginning, so I'm just going to go over a little bit of what we covered. Let's see. In the last 3 weeks, we explored the basics of the stock market and some broad strategies that investors employed to try to beat the market. So in the first week, we examined what it means to own stock. We then discussed why businesses may decide to go public and issue stocks. And after that, we looked at why average people like you and I should care about finance and investing. And then finally, we talked about what market prices mean and how it relates to the investor's perception of of company value. And then on week 2, we started looking into some strategies. So risk and reward is a major concept that I hope that you take away from this program. We distinguished systemic risk from idiosyncratic risk, and we talked about how diversifying your portfolio, adding a variety of different, hopefully unrelated assets will reduce your exposure to idiosyncratic risk. Then we went over 2 strategies for investing. Value investing is all about picking stocks that you believe have a greater intrinsic value than is currently reflected in its market price. Meanwhile, growth investing is all about picking stocks that you expect to grow in the future, either through sales, new projects, expansions. You get the idea. And then last week, we covered a lot of new things, so I'll go over it in a little more detail. The first thing we talked about was market indices. So basically, these are hypothetical portfolios created by financial firms that are filled with companies that represent a market segment. So the Dow Jones Industrial Average and S&P 500 are both really great examples of market indices that represent the US stock market. And then you also have the DAX, FTSE, and Nikkei, which each represent the stock markets of Germany, the United Kingdom, and Japan, respectively. In general, market indices are usually used as indicators to outline general trends in a specific market segment. And then we discussed investment strategy, momentum investing. The strategy involves technical analysis, which is a whole other complex topic. But the general idea is that momentum investors try to take advantage of continuing market trends. So this means establishing long positions when indicators show an upward trend, and establishing short positions when indicators show a downward trend. And then we also introduced another type of investment asset besides stocks, which are bonds. So when you buy bonds, you're basically acting as a lender and giving money to whatever entity is issuing the bond, which are usually governments and corporations. And then the entities that keep the borrowed money, they keep the borrowed money for a duration of the bond's maturity period. Meanwhile, they pay the holder of the bond fixed periodic payments based on an interest rate, which is why bonds are called fixed income assets. So once the bond matures, the issuer repays the original amount, also known as the principal, back to the bondholder. And then we finally discussed limit and stop orders. So limit orders allow investors to buy and sell at a specific price or better rather than the market price. So if you want to buy at a lower price than the current trading price, you would set a limit order at the price you want. And if the market price passes the threshold price, then your order will execute just like a market order. And this is the same for sellers, but reverse. And then stop orders are like the exact opposite of limit orders. Their purpose is to limit losses. So if you want to buy, but there's a certain limit of how much you would buy at a certain, how much you'd buy a certain stock at, then you would establish a stop order at a ceiling above the market price. So then that way, if the price ever goes past your set threshold, your buy order will be executed just like a market order. And of course, it's the same for sellers, but reverse. So there seems to be some confusion surrounding limit and stop orders. So let me know via email if you want some more clarification. So then, now that we've kind of wrapped up the recap, we're going to start looking into Unit 2 of the financial sector. So what is Wall Street? So the term Wall Street is widely used across the world to describe America's financial sector. And because it's really difficult to talk about the financial world without referencing Wall Street, so I'll try to clarify what this term means exactly. So Wall Street is an actual street located in the lower Manhattan section of New York City. It got its name from the wooden wall Dutch colonists built in lower Manhattan in 1653 to defend themselves from the British and Native Americans. And the name stuck, even after the wall was taken down in 1699. However, nowadays, it's the home of major American financial entities, from stock exchanges and large banks to brokerages and credit rating agencies. So we'll try to go over these entities and how they work in conjunction with one another in the next few weeks. Wall Street has been the historic headquarters of some of the largest financial firms across the world. So that makes New York City commonly regarded as the financial capital of the world. So despite Wall Street being a specific geographic location, it has also become an umbrella term to describe the global financial investment sector in general. So it's oftentimes used to contrast with Main Street, a metaphoric term used to describe small businesses, employees, workers, individuals, and middle and low socioeconomic classes. So politicians and the media have often used Wall Street and Main Street to describe economic events and social inequality. So that's often, as most of you may know from keeping up with politics, a perceived conflict between Wall Street and Main Street. And this has led to a lot of socioeconomic and political strife throughout the decades. Before we can understand the conflict that lies with the perception of Wall Street for average Americans, we first need to examine what Wall Street and the financial world at large are. So that's what we'll try to do in these next 2 weeks. So stock exchanges. A big part of Wall Street are the exchanges themselves. So what are they exactly? Well, throughout the first weeks of our investment club seminars, you've probably heard that the two biggest already are the New York Stock Exchange and the NASDAQ. So simply, these are the marketplaces where buyers and sellers meet to trade stocks. And your typical investor would rarely come into contact with these exchanges. Often the brokerages do the trading, but nevertheless, it's paramount to understand them. So exchanges are the underlying foundation supporting all the action of on the stock market. So at their core, they provide investors with a place to turn their stocks into cold, hard cash, and companies with a launchpad for their public market presence. So without them, stocks would just be imaginary. They would hold imaginary value. There are 4 types of exchanges: auction exchanges, electronic exchanges, electronic communication networks, and over-the-counter exchanges. So, for example, the New York Stock Exchange is an auction exchange. And here, buyers and sellers place bids and asks until a price agreement is met and the stocks are exchanged. The New York Stock Exchange is the Wall Street equivalent of, basically walking into a brick and mortar Nike store to buy some shoes. Electronic exchanges like the NASDAQ would be like visiting Nike's website, for example, and purchasing shoes digitally. The trading efficiency of these exchanges has attracted billions of dollars of transactions every day. And then continuing with the retail analogy, electronic communication networks, or ECNs for short, and over-the-counter marketplaces, or OTCs, would be like the eBays of retail. So then ECNs provide investors with more direct contact between buyers and sellers, thus removing some market friction. And over-the-counter exchanges are comprised of smaller companies that were possibly removed from the New York Stock Exchange or the NASDAQ. And on OTCs, there is less regulation and oversight. So this makes some investors wary and others more eager to take the risk of investing in them. And then we have hedge funds. So what is a hedge fund? Well, first of all, let's dissect the word. Hedge fund is a combination of 2 words, hedging and fund. So hedging basically means, reducing risk, holding an investment position intended to mitigate losses. And then fund means, money pooled together to be used for investments. And so hedge funds are an alternative investment firm designed to protect investment portfolios from market uncertainty while trying to generate positive returns in both upward trending and downward trending markets. So the primary aim of most hedge funds is to reduce volatility and risk while trying to preserve capital, and also and this is really important, trying to deliver positive returns under all market conditions. So the characteristics of hedge funds include, they have little to no regulatory oversight. So that means that they don't have to register with the U.S. Securities and Exchange Commission, the SEC. They're very illiquid. So a fund may lock in investors for 2 years or more. So it's really hard to convert the money that you may have invested in a hedge fund back into money. And they have really aggressive investment strategies usually. They're trying to do this basically to post a higher return. So a hedge fund manager does things like differently, like short selling and leveraging. And then you have high fees, complex investment structure. So complex incentive structure rather. Fund managers receive like an annual fee equal to 2% of the assets in the fund and an additional bonus equal to 20% of the year's profits. And then unfortunately, you also have biased performance data. So fund managers don't have to report performance numbers to anyone other than their fund investors. And then you have brokerages. So if you want to buy or sell a stock, you can't place an order with a stock exchange directly. Like you can't just go to the New York Stock Exchange and say, I want to buy or sell a stock. So instead, you place your stock trade through a stock brokerage, who then deals the exchange on your behalf. So becoming a brokerage, like if you want to start a brokerage firm, it's very competitive. So it requires a firm to first become a member of the stock exchange. And these memberships cost a ton of money, and have very strict regulatory requirements. And there are four main types of brokerages: a stockbroker, a foreign exchange broker, also known as a forex broker, a full service broker, and a discount or limited services broker.
You're selling new clients, selling new limited partners. You got to build that business. And on the other side of it, you get to deploy and you get to make money and you get to deploy in the market for, if you're a financial manager, if you're somebody like me, we're dealing with startups, we're deploying capital into deals for startups. So my day is typically spread out between those three things. Before COVID hit, I had a super fun job. People were taking me out to dinners. I would host my own dinners. They'd be paid for by accountants and lawyers and all this stuff. They'd be in the hills of Beverly Hills, of Bel Air. We'd have these beautiful dinners every quarter, invite all these really awesome founders, all these awesome investors out. Super fun. And then COVID hit and it was like, everything you're going to do is on Zoom and text and email. So it totally changed what my day-to-day looked like. The other thing I do a lot of is talk to other venture capitalists, talk to other VCs. So what deals are you looking at? What are you excited about? How can I give you a deal? How can you give me a deal? How can we invest capital together? Because I like you and you're smart and I'm smart. So we can come together and do really cool things. That's a big part of my job too, is putting together a deal. Okay, we got this great startup. The technology works. My team at Hawk Media loves it. We got a couple VCs coming into the deal. Who else can we bring in? And that's the fun part, is the deal making part. It's like, it's exciting. And then you deploy the capital, then you got to go get the results. And then I got to go report out on the results. My firm, every month we send an update to our LPs, which nobody does. That's like not something that people do. But we wanted to create a more closer relationship with our LPs, key them into the deals we're looking at. So that's kind of what a day looks like for me. It's a bunch of different things. But typically it's all about, again, it all revolves around the CEOs and the startups we've invested in, and then looking at new deals and raising more capital.
Yeah. And I think I have one final question for you. So do you have any like final advice or any like one thing that you would have people take away for students who may want to go into business, finance, economics, all this stuff?
Well, I think my advice is going to be, again, like I got my start running a record label in high school. Like, that's what I was super passionate about. I loved it. I had deep experience. I didn't have to get paid a dime to love every second of what I was doing. And, just if you're looking for a way to be successful in business, find something that makes you super stoked to get involved. And it's something you have an affinity for. Maybe it's esports, maybe it's investing, maybe it's, maybe there's a bunch of different things that you might be super into. But find something you really love and lean into that, because everything's a lot easier when you're super passionate and stoked about it. I'm going to be honest, like the suit company thing, it took me like 2 years to really get into it. Like I just wasn't that into it the first 2 years. I'm look at what I'm wearing. I don't wear suits. Like I'm a total crazy person with my clothing. I don't wear suits. I don't love it, but like it was a cool business and I built the tech and did the marketing and whatever. But took me a really long time to really get into it and be like, okay, well, like I actually really like this. This is cool. Like I want to get into this in a bigger, deeper way. So like my like align what you're going to do in your career with your personal why. Go read Simon Sinek, Starting with Why. Just go read that. And then think about what he has to say about why particular topics matters to you, and then read about what he has to say about how that affects the way you feel, the energy you bring to the table. It takes so much energy to be successful, and it's not like the kind of energy of like, okay, like I'm just going to do what my teacher tells me, I'm going to study, I'm going to take a test, and I'm going to go. It's like, no, there's so much unknown, there's so much emotional risk, and you have to wake up every day and you got to do it anyway. And if you don't love what you're doing, it's going to make it a lot harder.
All right. Yeah.
Ryan, what are
stuff.
you really enthusiastic about right now? What are you what are you stoked on right now?
Right now, well, let's see, I started getting into economics and finance in around ninth grade when I read this book for this summer program. I just picked it randomly, and I think that, that was fate right there. The book was called Basic Economics by Thomas Sowell, and I just got really hooked, and I started learning about the economy and how it really relates with our society and how it's really built, like how it's like, the invisible hands that are moving like our society around, like without like most Americans understanding it. So that's why I started this organization, focusing on, financial literacy. I'm trying to, teach students, economics, finance, business, all that stuff. So
it's awesome. There, right before I started talking, there was all these slides, and I was like, man, like I should take this class. Like, what am I doing? Like, I need to learn this stuff. Mm-hmm. It's good stuff to know. Really is. I pay so much attention to the public markets now that I invest in companies that are going to get bought by companies in the public markets. I've started to pay way more attention to it from like a macro perspective, but it's really great that everybody's here and they're learning all this stuff. When I was your age, I wasn't talking to VCs. I wasn't talking to people in finance. I was making music and throwing shows in basements and, passing out flyers and messaging chicks on MySpace to come to my show, which worked all the time. But it was a business, and we figured out how to use social media and run this little business,
Yeah. I mean, different paths for everyone. Right.
Everyone's got a different path. I always say the path to venture, there is no straight path to venture. Everyone's path is super windy, and they go down all these crazy roads. And if anybody's interested in venture capital too, I'm happy to talk to you after, or feel free to reach out to Ryan or me directly. I'm just Drew at hawkmedia.com. I'm happy to be a resource.
All right. Thank you, Drew. Let's see. So currently what we have planned is we're going to talk a bit more about the stock market game, and then we're going to do a Kahoot. So let's move on right here. So let's see. Oh yeah, so now we have mutual funds. So mutual funds are a really cool type of investment vehicle that you can invest in for the stock market game. So these consist of portfolios of stocks, bonds, or other types of assets that can be managed by the firms that run these mutual funds. Some really good investment firms that manage these funds include Fidelity, Vanguard, and BlackRock. You might have heard of some of them. These firms give individual investors like us access to diversified, professionally managed portfolios at a really low fee. So when you're looking to buy shares of a mutual fund, the price you're looking at is called the net asset value per share. It's called the net asset value per share. So a fund's net asset value is calculated by dividing the total value of securities in the portfolio by the total number of shares outstanding. So the price of a mutual fund is updated once a day after the US stock market closes, usually between around 4 to 6 p.m. And then something else that is really related to this is index funds. So index funds are really another really important investment vehicle to understand for investing. It's a type of mutual fund or exchange traded fund, something that we'll discuss later next week, that consists of a special portfolio constructed to track the components of a specific financial market index, such as the Dow Jones Industrial Average, the S&P 500, or the NASDAQ. So investment funds are generally considered ideal core portfolio holdings for retirement accounts, such as individual retirement accounts like IRAs and 401k accounts. Warren Buffett, the legendary investor himself, has recommended index funds as a safe haven for saving for retirement. So rather than picking out individual stocks for investment, he has said that it makes more sense for the average investor to buy all of the S&P 500 companies at a low cost in an index price offers. So index funds are ultimate in diversification, and they're really great for strong long-term returns and ideal for passive buy and hold investors. However, they're also very vulnerable to market trends, and they have no human element or flexibility like a normal mutual fund does. So if the market drops, there's really no human there to kind of prevent happening. So then your index funds will drop in price as well. So index funds might not play as big of a role in our investing for the stock market game, given that we are playing for the short term. But I think it's still a very valuable investment asset to understand for the future. Peter from last week was also talking about how index funds are really the way to go. All right, so now we have a Kahoot that will kind of test our knowledge in all this. So let's see. People in and we'll start. Question number 1. Risk and reward usually have what kind of correlation? And most of you guys got it. It has a positive correlation, so meaning as risk goes up, so does reward, usually. Question number 2. What is a way to reduce idiosyncratic risk? And most of you guys got that one as well. Very good. Question number 3. Which of these is a fixed income asset? Yeah, bonds would be the fixed income asset because they have fixed periodic payments that they pay over the course of their maturity. Which city is known as the financial capital of the world? In New York City, home of Wall Street, the New York Stock Exchange, all those major investment firms. The term Main Street usually refers to what? All right, yeah, a bit divisive on this one. So yeah, the term Main Street usually refers to, the middle lower class individuals, small business owners, as opposed to the people on Wall Street who are, the large banks, the stock exchanges, the hedge funds, all those like big money entities. So NASDAQ is what type of stock exchange? you guys got that one. So NASDAQ, as opposed to, the New York Stock Exchange or the London Stock Exchange, is electronic. So it's all online. Question 7. What is the objective of hedge funds when the markets are volatile? Yeah, so most of you guys know, as most of you guys have guessed, the objective of hedge funds is to deliver positive returns under all market conditions. So this means like setting up those really complex long positions, short positions, and different things that are. It's just hedging as a strategy is very difficult to understand. But the general gist is just we have to make sure no matter how the markets are doing, whether they're volatile, whether they're going up or down, always deliver positive returns. The next question, what entity do you contact to place orders that go to stock exchanges? And most of you guys got it. Brokerage firms is where you would go to place those orders. Question number 9. Mutual funds are diversified and professionally managed without any effort from the investor. Yeah, most of you guys got it. This is true. And question 10, what type of asset is considered an ideal core holding for retirement accounts? Yeah, index funds are definitely ideal because, most of them aren't, even though they're not managed, they usually have really strong long-term gains. Okay, question 11. S&P Global has what role on Wall Street? I think a hint here would be, where have you heard the term S&P before? Yeah, so S&P Global, they created the S&P 500. So basically they are a financial analytics and credit rating agency, meaning that they rate how good of an investment other assets are. They also create those market indexes such as the S&P 500. So they're not a stock exchange per se, but they play a huge role in the stock exchange. All right, which stock exchange has the largest market cap? Yeah, the New York Stock Exchange, definitely the biggest in the world. All right, 13. Which tech media company dropped hard this week after weak earnings? That's something you have to pay attention to. Yeah, so Netflix is the one that dropped really hard this week, mainly because their earnings just came out, and it seemed like they weren't getting as many as much growth in terms of subscribers as they would have wanted. So, all right, 14. As of July 2020, which presidential candidate is leading in the polls? That is correct. Joe Biden is currently leading in the polls. So we'll see if that changes or if that'll stay the same as we approach November. All right, last question. Which of the following is only a major Wall Street investment bank? So not anything else. So Goldman Sachs, so Chase Bank, Mega Van Arbor, and Wells Fargo all have investment bank divisions, but they're mainly focused on retail banking. So Goldman Sachs is an entity that solely focuses on investment banking. Congratulations to Jessica, Miles, and Ava. Once again, no prize, but congratulations nonetheless. All right, so as we wrap up here, we're just gonna look at the rankings. Congratulations to everyone that made the top 10. You guys are hitting some really strong returns, and even just as beginner investors, like this is really good stuff. And then finally, next week we're gonna look into this is for this week, but next week we're going to look into banking. One more thing. We're actually, if you look at our Instagram, if you've been following our Instagram, we are actually hiring, and anyone from middle school through college are welcome to apply. We're looking for curriculum developers, designers and animators, people who can do PR and manage social media. So if you're interested in that, this is our Instagram page at mezo.inc. You can also visit our website. And you can apply from there. So thank you guys for coming out, and have a great weekend.